Hello, guys. This is Vinit from Edge Forex, and today we are going to talk about something that controls your money, your emotions, and the entire financial world. Yet, most people don't even realize it's happening. Have you ever wondered why a stock that everyone loves suddenly crashes? Or why everyone seems to be rushing into the same investment at the exact same time only for it to lose value? It's not magic. It's not a conspiracy, it's psychology. It's a battle between the sheep and the wolves. Today, we're pulling back the curtain on the classic market dynamic, and I'm going to explain what a trend actually is, why you are probably a sheep more often than you think, and how you can start thinking like a wolf to protect and grow your money. So let's get comfortable and let's dive in. All right, let's start with the basics. What is a trend? It sounds like some complicated financial term, but it's really a fancy word for direction. Think about ocean. You have waves crashing in on the shore, but you also have the tide. The tide is the overall long term direction of the water. It's either coming in or it's going out. Those little waves, they are day to day fluctuations, the noise, the tide is the trend. In the markets, a trend is the overall direction that prices are moving over a certain period of time. It's a very simple concept, but it is the foundation of everything else we are going to talk about. Now, there are three main kinds of trend you need to know about. First, you have an uptrend. You might hear it. This is called as a bull market. This is when the prices are generally moving up. Imagine a staircase. Each step up is higher than the last. This means the overall mood of the market is positive. Investors are feeling optimistic, they are buying, and they are willing to pay more. Second, there is a downtrend or a bear market. This is the opposite. Prices are generally moving down. It's the staircase going down. The overall mood is negative, pessimistic. People are selling, often out of fear. They are accepting lower and lower prices just to get out. And then, third, you have a sideways trend. It's a bit like car driving on a flat, straight road. Prices aren't going up or down, they're just bouncing around in a narrow range. This is a period of indecision where buyers and sellers are in a standoff. Now, here's the key point. These trends exist on different timelines. A stock could be in a long term uptrend, a secular uptrend, for decades. Think about it, rise of technologies companies like Apple or Microsoft. But within that long term trend, it might have a short term downtrend for a few months, which we call a correction. It's like a long car ride from coast to coast with some traffic jams along the way. The overall direction is still forward, but there are moments of slowing down. So now we have established what trends are. But here's a $1 billion question. What actually creates these trends? It's not some mysterious algorithm, it's not a robot, it's us. It's our collective human psychology. And that is where the sheep and the wolves come in. Let's talk about the sheep. Now, I want you to forget the cute, fluffy cartoon image you have in your head. In the market, a sheep is an investor who follows the herd. They act based on what everyone else is doing, not on their own research or independent thought. Let's be honest, we've all been a sheep at some point. Think about the time when a new restaurant opened and everyone was talking about it. You saw this huge line out the door and you thought, "Hey, it must be amazing. I have to go there and I try it out." You didn't read any reviews, you didn't check the menu, you just noticed the line. Now, that's a classic example of herd mentality. You assume that if a lot of people are doing it, it must be the right thing to do. In the markets, this herd mentality is a powerful and a dangerous force. That's what creates irrational trends, bubbles, and eventually crashes. So, how does it happen? I want to tell you a story you probably heard of, the dot com bubble. In the late 1990s, the internet was new and exciting. Suddenly, a company didn't need to be profitable. It just needed to have a .com at the end of its name. Everyone, and I mean everyone, was buying these stocks. It was a massive wave of sheep mentality. Your neighbor, your taxi driver, your aunt, everyone is talking about how they were getting rich from these tech stocks. Why? The fear of missing out, or FOMO. People saw prices going up every day and thought, hey, I've got to get into this. I don't want to be the only one left behind. Think Bitcoin. The collective buying fueled an incredible uptrend. Prices went to absolutely absurd levels, completely detached from what the companies were actually worth. It was a classic positive feedback loop. Prices go up, sheep see rising prices and get excited. They buy, which pushes prices up even more. More sheep see the rising prices and join in. Repeat. This is the sheep mentality in full force, creating an overextended trend. It's a bubble. Think what happens to a bubble. It pops. Think Bitcoin. The scariest part of sheep mentality isn't the buying, it's the selling. When the bubble finally bursts and a small crack in the dam, a piece of bad news is all it takes. The herd's mood shifted from greed to panic. The positive feedback loop becomes a negative one. Prices start to fall. Sheep see the portfolio shrinking and get scared. They panic sell to cut their losses, which pushes prices even more. More sheep see crashing prices and rush for the exits. Repeat. This is why downtrends can be so vicious. The sheep who bought high on excitement end up selling low in a fit of fear. They lost money not because the market is rigged, but because they let their emotions and the crowd's action dictate their decisions. So while sheep mentality is a powerful engine for trends, it often ends in tears for people involved. But there's another side to the story. If the sheep are the ones getting fleeced, who are the ones profiting? It's the wolves. Now, when I say wolf mentality, I'm not talking about a character from the movies. I'm not talking about someone who's greedy, manipulative, or unethical. I'm talking about a different kind of wolf. The one who is an independent, strategic, and disciplined thinker. The one who hunts for opportunities that others miss. The wolf is an investor who thinks for themselves. They conduct their own research, they analyze the facts, they make their decision based on logic, not emotion. And most importantly, they're often contrarians. They're not afraid to go against the crowd. The most famous wolf of all time is probably Warren Buffett. He has a simple philosophy that perfectly sums up the wolf mentality: be fearful when others are greedy, and greedy when others are fearful. Let's break that down. Remember the dot-com bubble we just talked about? While all the sheep were piling into tech stocks, chasing ridiculous valuations, wolves like Warren Buffett and other smart investors were sitting on the sidelines. They were being fearful of a market that was getting irrationally greedy. They saw these companies were not worth what the crowd was paying. They did not participate in this madness. But what happens when the bubble pops? When the sheep panic and start selling off everything and prices plummet? That's when the wolves get to work. They become greedy. They see high quality companies may not be in the tech space, but now are on the sale for a fraction of their true value. They buy when everyone else is terrified to. They're buying when the blood is in the streets. So the wolf mentality doesn't just ride trends, it exploits the extremes of trends that are created by the sheep. When a trend becomes an overblown bubble, the wolf sees an opportunity to sell or short the market, betting on the inevitable crash. When a trend becomes panic fueled crash, the wolf sees an opportunity to buy low, betting on the inevitable recovery. The wolf understands that markets are a cycle, they are cyclical. They know that after a period of irrational exuberance, a downtrend will come. And after a period of intense fear and panic, an uptrend will eventually return. They position themselves to profit from these natural shifts. And that's exactly what Warren Buffett is doing right now. Their cash position is the highest in the history of Warren Buffett's investments. Why? Because the valuation of the markets are the highest in the history. They're higher than dot-com bubble. They're higher than the real estate crash. They're highest ever. The wolf mentality isn't about being cruel, it's about being rational. It's about having the emotional discipline to stand apart from the crowd and trust your own judgment. So, you've laid it all out. Trends are the direction of the market, driven by the collective psychology of investors. Sheep amplify these trends to dangerous extremes, creating bubbles and crashes, and wolves exploit these extremes for profit. Now, you might be thinking, that's great, but how does that help me? I'm not a big shot investor. The most important lesson here isn't about being a professional trader. It's about recognize that both the sheep and the wolf are inside you. Every single one of us has the tendency to be a sheep. We get caught up with the excitement. We get scared by the headlines and we feel that pull to follow what everybody is doing. That's just human nature. The goal isn't to eliminate the sheep, the goal is to cultivate the wolf. Here are three simple things you can do to start thinking more like a wolf. Do your own research. Don't buy a stock or a forex pair just because your friends or some influencer on the social media told you so. So, understand what a company does, understand the fundamentals of an economy if you're trading forex, how it makes money, and if it's a good investment for your goals. Have a plan. Before you buy, decide when you're going to sell. Is it based on a price target, a specific period of time? Having a plan helps you avoid making emotional decisions when the markets get crazy. Think long term. One of the biggest advantages of the wolf is patience. They can wait out the madness. If you invest for the long term, the short term noise of a trend, the panic, and the excitement become far less important. The next time you see the news reporting on the markets, the latest trend, or you hear people talking about the next big thing, don't just see the numbers, see the psychology, see the sheep, and ask yourself, which one are you going to be? And which one are you going to listen to? The choice is always yours. So that's it for today. And I really hope I got my point across. And if you have any questions, I'll be more than happy to address. And do leave me some comments, give me some feedback. And that's it for today. Go be a wolf. Hello, guys. This is